Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 232 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about something that is probably applicable to a large number of you. And if you have kids, you need to open your ears for this particular episode because we are going to be talking about the child tax credit for 2021, exactly what it is, exactly what it looks like, and exactly how it can help families in need. And if you don't necessarily need it, but you get it anyway, maybe how you should use it and what it means for you and your taxes moving forward in the year 2021. So stick around for all that and more information on that tax credit in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just go on any of those major social media sites and DM me, message me, and tell me that you are interested in financial coaching sessions. And we can begin working together and creating financial goals that are specific to your situation and helping you to meet those goals, and then ultimately helping you to attain long-term financial freedom, which is what I hope for every single person who watches or listens to this show on a daily basis. Now, over the last year or so, right, year and a half, I guess, there has been a lot of talk of stimulus, right, and a lot of talk of helping working families, and a lot of talk of getting out of this pandemic, not just in a sense of getting the virus gone and getting people vaccinated and all those types of things, right? But also when it comes to the financial and the economic implications that the pandemic has had on our lives, right? So a lot of legislation has been passed. A lot of things have come in and out of Washington over the past year. And it's really important to note a few of them are going to impact your life. Right? Like the stimulus checks have impacted the lives of many, many individuals. And those stimulus checks, if you made below a certain amount, right, you were going to receive a stimulus check. And it's just one amount of money that you're going to receive. And, you don't have to pay back and you don't have to pay taxes on and none of that, right? And we've talked about stimulus checks before, and you can go back and look at some of those episodes. But they may not be as useful now that we're not likely to receive any more, right? But the stimulus check is not the only thing that can be given directly to families, and that is going to be given directly to families. What is also going to be provided is this child tax credit, right? This enhanced child tax credit, which was set up and expanded under the American Rescue Plan that was passed earlier this year, right? That is going to help families directly as well. And maybe you don't need the help, but regardless, it's going to send you money as well. Now, how exactly do these work, and what's a tax credit, and blah, 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 blah. Well, let's just start with what a tax credit is, and then we'll get into some of the minutia of exactly what this tax credit is going to do and how it is going to help you if you have children. Okay, so a tax credit is just an amount of money that taxpayers can subtract directly from their taxes owed to the government. Unlike deductions, which reduce the amount of taxable income, tax credits reduce the actual amount of taxes owed. Okay, so let's just say that you are contributing to a traditional IRA. We've talked before about how if you contribute to a traditional IRA, it decreases your taxable income, right? It creates a tax deduction for however much you decided to contribute. Now, $6,000 is currently the annual limit. So let's say that you contributed $6,000. Okay, so you get a tax deduction of $6,000. Now, let's say that you're in a 25% tax bracket, which doesn't exist in a perfect way right now to have, you'll pay exactly 25% of taxes. But let's just use it for example. Let's say you were in a 25% tax bracket, you take that $6,000 deduction. What that means is that your taxable income is going to decrease by $6,000. Okay, so if you were making $70,000, now your taxable income will only be $64,000, right? And what that does is it saves you taxes on a certain amount of income. Okay, so that $6,000 that would have been income, you would have had to pay taxes on it of 25%. So you would have had to pay $1,500 in taxes on $6,000. Okay, now you are saving yourself $1,500 in taxes by taking the $6,000 tax deduction. Okay, so that's what a tax deduction does. It decreases your taxable income, and then it will decrease the amount of taxes that you pay subsequently because there's less income to be taxed on. Okay, so that's a tax deduction. But what a tax credit is going to do, right, is going to look at the amount of taxes that you owe, right, and that credit is going to decrease the amount of taxes that you owe over a particular year. Okay, so if you owe, let's say, on a $60,000 a year salary, let's say you owed the government $10,000 in taxes, and you got a $2,000 tax credit. Right? Now you're only going to owe the government $8,000 in taxes. Okay, this isn't decreasing your taxable income by a certain amount. What it's doing is it's decreasing the exact amount of taxes that you owe by a certain amount. Okay, so that's the difference between a credit and a deduction. Okay, now the value of a tax credit depends on the nature of the credit. Certain types of tax credits are granted to individuals or businesses in specific locations, classifications, or industries. Now, tax credits typically come in three different forms. Okay, they come in the non-refundable form, they come in the refundable form, and then the partially refundable form. So let's break these down really quick, okay? Non-refundable tax credits are items directly deducted from the tax liability until the tax due equals zero. Any amount greater than the tax owed, resulting in a refund for the taxpayer, is not paid out, hence the name non-refundable, okay? The remaining part of the non-refundable tax credit that can't be utilized is lost in effect. Okay, so non-refundable tax credits are valid in the year of reporting only, expire after the return is filed, and may not be carried over into future years. Okay, so that is what a non-refundable tax credit is going to look like. Then what about the refundable tax credit? Well, the refundable tax credit, they are the most beneficial credits because they're paid out in full. This means that a taxpayer, regardless of their income or tax liability, is entitled to the entire amount of the credit. If the refundable tax credit reduces the tax liability below zero, the taxpayer is due a refund. Okay, so what does this look like? This looks like, let's say you owe a certain amount of taxes. Let's go back to, let's say you owe $10,000 in taxes, right? With a non-refundable tax credit, right? Let's say somehow you got a tax credit for over $10,000, right? You would only be able to take away that $10,000 tax liability and no more, right? But with the refundable tax credit, you could take away the entire tax credit amount. Okay, so let's say it were more than $10,000, then you would receive a return, you would receive a refund of that particular amount that was above the $10,000. Okay, so this is why a refundable tax credit is going to look better for the individual who's receiving it. As of the 2020 tax year, probably the most popular refundable tax credit is the Earned Income Tax Credit. This is for low to moderate income taxpayers who earned an income through an employer or working as self-employed or with a business or farm and meet certain criteria based on income and number of family members. Other refundable tax credits include the Premium Tax Credit, which helps individuals and family cover the cost of premiums for health insurance purchased through the health insurance marketplace. Okay, so this is something that is interesting because it can decrease your taxes and decrease it to a point where you actually get a refund because of the tax credit. Then there are partially refundable tax credits. Okay. Now, some tax credits are only partially refundable. The child tax credit became refundable up to $1,400 per qualifying child in 2018 as a result of the Tax Cuts and Jobs Act. Right? If a taxpayer has a large enough tax liability, the full amount of the child tax credit was $2,000. However, up to $1,400 is refundable, even if it's more than the taxpayer owes. Right? So you can see how this is a partially refundable tax credit and not a completely refundable tax credit. Now, another example of a partially refundable tax credit is the American Opportunity Tax Credit for post-secondary education students. If a taxpayer reduces their tax liability to zero before using the entire portion of the $2,500 tax deduction, the remainder may be taken as a refund credit up to the lesser of 40% of the remaining credit, or $1,000, right? So they just put limits on the amount that you can receive a refund for these particular credits that you may receive, okay? So these are the different types of tax credits. Now, what type of tax credit are we talking about today? Well, I actually alluded to it just a moment ago, the child tax credit. Now, I talked about the child tax credit in the way that it was when the rules for it were stated in 2018. Right? But it has changed, and it has changed for 2021, right? It has changed for individuals who are going to pay taxes in the 2021 year. So what exactly is this new child tax credit going to look like, right? Well, what's going to happen is that individuals who have children are going to be paid in advance instead of just when they file their taxes and getting the tax credit then. They're going to be paid in advance leading up to the year 2022 and the tax season for the year 2021, right? They're going to be paid monthly for this particular tax credit and receive an amount of tax credit on the taxes that they file in the year 2022 for the 2021 year. Okay, so how does this look? What does this look like? The child tax credit payments, which were set up and expanded under the American Rescue Plan passed earlier this year, amount to $3,000 annually per child ages 6 to 17 and $3,600 annually for children under the age of 6. So if you have children age 6 to 17, right, you're going to get $3,000 per child. Okay, but if you have children under the age of 6, you're going to get $3,600 per child for each of those children. Okay, now there are rules that apply, obviously, and that's what I want to talk to you guys about. But this is the amount that you will be able to receive. Now, eligible families will receive half of their tax credit in the form of a monthly payment, up to $250 per school-age child and up to $300 per child under the age of 6 from July through December 2021. The other half will be paid out when they file their 2021 taxes. The credit is income-based and starts to phase out for individuals earning more than $75,000 a year or $150,000 a year for those married filing jointly. Okay, the IRS is set to send checks to 39 million eligible households, and they will send them basically in the middle of each month from July to December. So what's this going to look like? What this is going to look like is, let's just use the example. Let's say you have 2 children. Okay, and one of your children is, let's say, 7 years old, and one of your children is 4 years old. Okay, so what you are going to receive is you're going to have a tax credit of $3,600 for the 4-year-old, and you're going to have a tax credit of $3,000 for the 7-year-old, right? So quite the tax credit, quite the big deal here. Okay, so you're going to receive those tax credits. Now, you're not going to receive them just when you file your taxes, just when you're on TurboTax and putting in your information. That's not going to be the only time you receive that tax credit. Okay, what's going to happen is they're going to take half of that tax credit, so $1,800 for the 4-year-old and $1,500 for the 7-year-old. Okay, so we're looking there at $3,300. Okay, they're going to take $3,300 of those tax credits, and they're going to pay it out to you in monthly payments. Okay, so $250 a month for the 7-year-old, $300 a month for the 4-year-old from July to December, right? You're going to get one payment per month. All right, but then when you go to actually file your taxes in 2021, right, you will receive the rest of that tax credit. Okay, so you will receive the other $3,300 tax credit on your taxes when you file them. Okay, which may end up being a refund for you, may end up just decreasing your tax liability to a point where it's actually reasonable for you, right? And this can bring about a lot of different considerations and a lot of things that you need to take into account. And I'll cover a few of them towards the end of today's episode. But I want to continue talking to you because there are some things that you need to take into account with this particular plan. Now, it's important to understand that with these payments, the IRS is essentially prepaying a tax credit that you usually receive when you file your taxes, right? Because the child tax credit is not something that is new. It is something that has been around. Now, it is increased in amount, okay, but it is something that you would typically receive on your taxes, on your 2021 taxes. And if you have been receiving a child tax credit over time, right, you've been receiving it because you've had children, okay, then you really need to pay attention to what's about to go on because when you file your taxes, okay, it's still going to take into account all of your income, but what's going to happen is the amount that you're able to take out based on the child tax credit is actually going to decline because let's say, it was $2,000 per child, right? And it was just when you filed your taxes. Okay, well, let's say that you have that 7-year-old, and that 7-year-old, you're getting $3,000, but you're going to get $1,500 during 2021, and you're going to get $1,500 on your taxes. Well, that decreases the child tax credit when you file your taxes by $500 for that particular child. Okay, so that $500 tax credit that you're used to receiving, you would not be receiving. Okay, so you have to take into account the fact that this is just a prepayment of the particular tax credit that you would usually receive. So if you take that into account when determining the amount of money that you should receive in a tax refund or the amount of money that you should pay in taxes, you may need to do a different calculation this year, because that would actually decrease the amount of money you would receive for that child. Now, if you have, let's say, the 4-year-old, right, and you've had the $2,000 tax credit for them for multiple years now that would still decrease the amount that you would get when you filed taxes for them, but by a lesser amount than the older child, because that child is going to cut down to $1,800, right? They're going to pay you $1,800 throughout the course of 2021, and then $1,800 as a tax credit when you file your 2021 taxes. So regardless, the amount that you're receiving in tax credit, if you have had children and filed taxes on those dependent children, is actually going to decline. So you need to pay attention to the amount that you received as a refund last year, and be prepared if you didn't receive much or didn't receive anything or had to pay, right? You may have to pay more, or you may get your refund cut by a certain amount going into this next year. That's why you have to remember, right, that if this is the case, it would probably be smart to lay aside some of this money that you're receiving in 2021 and lay it aside and say, okay, this is prepaid my tax refund. Okay, so set aside the amount that you think you should set aside that would make up the total refund, and then continue to receive those payments, and you can use them for any number of things. Obviously, you should not blow these payments. You should do something that is commensurate with the particular part of the financial action plan or whatever financial plan you're working that you are in, right? What you should be doing with the money that you receive, if you are in a place where you need to pay off debt, you should be putting it towards paying off debt. If you're in a place where you're trying to build up an emergency fund, then you should be putting it towards your emergency fund. If you are investing and you're trying to put money towards your investments, then you should invest that money. And, I think that it'd even be a good idea to give some portion of that money, even though it's money that you would receive anyway, right? It would be probably a good idea to give a piece of that money just for the sake of financial balance. Now, who else may need to be careful when it comes to spending this money that is being given to you over the course of 2021 in these payments, right? There are many families who could be affected by this. And if you switch to a higher paying job, for instance, or your spouse went back to work after being unemployed for most of 2020, you could be in a higher tax bracket next year, which could change your tax math, right? And you have to remember that this 2021 tax credit, the way they're beginning it, is based on the individuals and how they filed their taxes in 2020. Okay, so you have to keep that in mind, because if your tax situation has changed, your income increased dramatically, right, then you are going to be in a situation where you may not qualify for this tax credit, yet you may receive it, which is problematic, right? You have to understand that this has changed, and you either need to let the IRS know, and they are setting up a portal that's supposed to be open in July where you can make changes to your information. You should let them know, right? And then any payments that you may receive, either ask them, how do I send this back or cancel this payment? Or figure out how you can set that payment aside because you know that's going to be money that you're going to have to pay in taxes when you come to your 2021 taxes in the year 2022. Also, right, if you sold property for a gain and therefore earn more income in 2021, you could possibly have to pay the credit back when you file your 2021 tax return because you owe more taxes than the credit is worth. Okay, if you fall into these categories, or you can afford not to use the credit payments immediately, you may want to opt out via the IRS portal. Okay, because you can do that. You can get online, and when they set up this portal, you can opt out of the payments. Okay, this is not a fun answer. It's not an answer that is going to put money in your pocket today, but it is going to save you from some tax heartache down the line. We don't want you to be distraught when you get that tax bill next year and not understand why, because you weren't active in understanding the tax laws that were associated with your particular situation. Now, to avoid running into issues, you may start at looking at your 2020 tax return to see where your finances stand. You can also consider talking to a CPA or some financial professional about your situation ahead of the first payment on July 15th. That way, you can either know if you should be receiving it in the first place, if you're receiving it, how much you should be receiving, and if you're supposed to receive it and they don't send one to you, what you should do and how you should go about that, okay? Because I happen to be in the situation because my wife and I had our first child last week. Our son was born last Thursday, where he's born so close to this particular deadline, and he wasn't born in 2020, okay, that he's not on our 2020 taxes. So we are going to have to tell the federal government that he exists. Okay, so they can begin sending us those payments. Because obviously, if you can receive the payments, you should want to receive them because it's more money in your pocket. It can help you to accelerate your financial plan. Now, are we saying that it's a good idea for the government to be sending you these payments in the first place? That is neither here nor there. I'm saying if you are going to receive them in the same way as when you receive stimulus checks, if you are going to receive them, you might as well use them for something good, right? And if you are owed them, right, if they have this legislation and you are part of the individual group that should be receiving them, then go and get your money, right? Understand that it is okay to claim what is going to be owed to you based on a certain amount of legislation. Okay, so I'm going to have to do that, and you may have to do that too if you've had a child this year, or if you have a child later this year, because you can still pick up those payments towards the end of the year. Now, what's going to happen, and what's likely to happen in my situation, and what could also happen in yours, is that it's likely, just based on Social Security numbers and birth certificates and all these different types of things, and it's the IRS, right? It's likely that we won't get paid for some period of time, right? Some short period of time, we will not get the payments. Now, whatever payments you don't get in 2021, right? 2022 is going to roll around and you will get a larger tax credit. So whatever they don't give you in the payments, it will increase your tax credit, right? It will, you'll still get the same amount. You'll still get the same amount of money per child, right? But it's just going to show up in the form of the tax credit and not the individual payments that you could be receiving. Now, if you're like, you don't really want to worry about the whole tax situation and whether or not you should be receiving the payments or whatever, you can go onto the portal that they're going to set up and just completely opt out. You can just say, hey, don't send me the advance payments. And if you say don't send me the advance payments, they won't, right? And if they don't send you those advance payments, then when you file your taxes, right, you'll see whether or not you should be receiving that child tax credit. And if you fall into the situation where you should be receiving it, then perfect, right? You can receive that child tax credit, move right along with your life, and you get the same amount of money, you just get it a little later, okay? But if you opt in and maybe something happens and you shouldn't have been somebody who was receiving the credits and you spent the money, and then you get to later down the line, you realize that you weren't supposed to receive that money in the first place, then you're going to owe the IRS some money, and that is not what we want. Now, what do we want here, right? What do I want the outcome to be for you guys? I want the outcome to be that if you're owed this tax credit, that you actually receive it, you know it's coming, and you make the preparations that are necessary, right? You understand if you're in the income tax brackets that should be receiving this money, that you should be receiving it. And if you're not, then you go to the IRS portals and you figure out why not, and you get these payments for yourself, because undoubtedly getting extra money every single month can help you along in your financial plan. Okay, and I want that to be the case if this money is owed to you. Okay, but if it's not, or you don't think it will be, it's okay to opt out of whatever they may be trying to pay you, or what would have been correct based on last year's tax data. But you need to do some homework. You need to sit down and realize whether or not your income has changed substantially, whether you've had some taxable gains that are going to really push your income into the stratosphere, or maybe not into the stratosphere, but just into the income section where you can't receive this tax credit or these advanced tax payments. Okay, so you need to be aware of your tax situation. You need to be aware of what you are going to be owed, right? And if anything changes in your life, make sure that you make the adjustments, right? Because who wouldn't love to have an extra $3,600 in the form of a tax credit if you have a child this year? Right? That's $3,600 that's going to go in my pocket. I think it should go into yours too. Don't make the mistake of missing out on this tax credit. Now, again, obviously, when you go to file your taxes next year, you can say, hey, I've got this dependent, and it'll show you that you're due the tax credit and you'll get paid the tax credit. Okay, but if you want to get these advance payments, which would be pretty awesome, especially if you have a first-time child because you haven't been receiving this tax credit. Again, some people have been receiving this tax credit just in a differing amount and just at the time when they filed their taxes. Okay, but if this is your first time doing this and your first time as a parent, as it is for me and my wife, right, it's going to be nice to get some monthly payments of $300 a month from July to December, or whenever they get around to us, right? And then get that tax credit next year. Okay, but if you just like the fact that you receive your refund after you file your taxes and you're content with that and you don't want to mess up your tax situation too much, it's perfectly fine to opt out. And I am totally not against that. But what do I think you should do with this money? Right? What do I think you should be doing with these payments? Well, it all depends on you, right? This can be a great way to go ahead and kickstart your financial life. Okay, it can be a great opportunity, just like I said with the stimulus checks previously, to get the ball rolling and actually start something. Because the biggest thing that people, argue about when it comes to, starting a financial plan or starting working on paying off debt or whatever is, I just don't have the money to do this. Well, guess what? You're going to have a little extra money each month, and if you have more kids, you're going to have way more extra money each month. Right? And what you can start doing is you can start building that 1 month emergency fund, right? Have that set up, have that 1 month emergency fund set up. Okay. You can begin paying off your debts, right? You'll have extra money to actually put on your debts and really pound away at them and get them out of your life, because that is not what we want. They are a strain on your cash flow, right? So you get to keep more of your cash flow if you get your debts paid off. And that's something you should be thinking about doing with these payments, right? So you can pay off your debt. You can, build up your emergency fund to 4 to 6 months of household expenses, because we want insurance against tragedy, right? We want to have money in case something were to happen, in case something were to occur, that we can pay for it in cash and not go into debt for that specific situation. You can invest some of that money or all of that money, right? But what I would suggest that you do, regardless, okay, is maintain financial balance with a windfall of money. I've told you this before, and I will stand by it, right? Any amount of money that you receive that you did not expect, do a little bit of each, right? You should be giving some, you should be saving some, and you should be spending some, okay? Now, again, if you're in a place where you're paying off debt or you're financially strapped, maybe you do a lot more of the saving some, or maybe you do a lot more of the spending some on your debts and getting your debts paid off, right? Maybe you're not doing as much in the way of saving and investing if you have debts, or maybe if you are trying to save up an emergency fund, you're not investing any of it and you're not spending a whole lot of it, but you're really getting that emergency fund built up, right? Wherever you're at in the financial action plan, really devote this money to that place. And if you are able to do that, if you're able to do that in a specific way over a 6-month period, and let's say you've got 3 or 4 kids, and so you're getting very large payments over this time period, right? It can really benefit you. Now, if you have 3 or 4 kids, again, it is likely going to impact your refund next year. Okay, you may not be getting a refund or be getting less of one, or may owe some taxes. Again, you're going to have to determine the tax situation for yourself, right? But if you're receiving these tax payments, make sure you use them for the right reasons, and make sure you use them on the things that are going to benefit you over the long term in your finances. But you have to do the homework. You can't just assume, hey, I'm receiving this money, let me go spend it, right? I'm receiving this money, it's something extra, I'm gonna just go blow it on whatever. And then it turns out next year when you expect a tax refund, you're not getting one, or where you typically owe 0 taxes, now you owe taxes, right? We don't want to fall into those situations. Talk to a CPA, talk to a tax professional to get your situation lined out. And if you're a first-time parent, make sure you sign up for these if you fall within the income tax limits that are there, okay? So I just want you guys to be aware of what's going on. I want you guys to be aware of something that is actually going to tangibly affect your financial situation if you have children, and this will absolutely do so. This will impact your financial situation if you have children, okay? And they are going to send these payments just, gung-ho without you knowing, if you aren't aware of this particular situation, and it can impact your taxes in a very real way. So you should be aware, and you should understand this is not another stimulus check. This is the advancement of a tax credit, and that is going to impact your taxes in a very real way. So be aware of that, and make sure you take the proper precautions, and then spend the money in a way that is going to help you out financially over the long term. So thanks for watching this episode. If you could, go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just message me on any of the major social media sites and tell me that you are interested in financial coaching, and we can begin working together in financial coaching sessions, building financial goals for you and your family, helping you to attain those goals, and then ultimately pushing you towards long-term financial freedom. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.